Hello and welcome to Stocksees. In this video, we will talk about real estate in simple terms and without confusing terms. We will see why prices rise over time when they can fall, and how this whole picture is connected to the stock market, real estate ETFs, and companies that live off rents. The goal is not to predict what will happen tomorrow, but to understand what is happening overall, so that we can see the market more clearly and more calmly. So stay until the end of the video. Let's get started. If you go back in time, you will see that every generation says that real estate is expensive. Our parents said it, our grandparents said it, we say it today. And yet, those who finally bought in each era usually say years later that they did the right thing. This creates the feeling that real estate prices are constantly rising and that anyone who doesn't get in on time is forever left out. The question is, however, whether this is really true or if we are simply looking at the market too superficially. To understand why real estate prices are rising, we must first understand the role that real estate plays in the economy and in our lives. Real estate is not just an investment. It is shelter, it is security, it is a necessity. A person may not want to invest in stocks, they may not want to take risks, but they need to have a place to live. This means that the demand for real estate never disappears. It may decrease in difficult times, but it does not go to zero. One of the most fundamental reasons why real estate prices rise over the long term is that land is scarce, but cities are growing. Jobs, universities, hospitals, and opportunities are concentrated in specific areas. More and more people want to live in the same places, but land is not growing. When demand increases and supply cannot keep up, prices are pushed up. This mechanism has been working for decades. A second huge factor is inflation. Over time, money loses value. This means that you need more money to buy the same things. But real estate is made up of land, materials, and labor. All of these things become more expensive with inflation. That's why real estate has historically been considered a form of protection against inflation. Not perfect, not without fluctuations, but much more resilient than simply keeping money aside. A third critical reason is interest rates. Most real estate is not purchased with cash, but with mortgages. When interest rates are low, more people can borrow, so more people can buy a home. This increases demand and pushes up prices. When interest rates rise, fewer people can afford the cost of the loan, and the market freezes or corrects. That's why the real estate market moves slowly, but is strongly influenced by the cost of money. In recent years, however, another important factor has been added: investors. In the past, a house was mainly for living. Today, for many, it is an investment product. Airbnb, short-term rentals, foreign buyers, investment funds, and companies that buy properties en masse. All of this adds additional demand to a market that is already under pressure. And when new demand is added, prices rise more easily. Somewhere here, the impression is created that real estate goes up forever. In reality, prices do not go up every year. There are long periods of stagnation where prices remain the same for years, but people only remember the periods of strong growth and forget the quiet periods. This creates the illusion of continuous growth. But the question remains: can real estate prices fall? The answer is yes, they can. They usually fall when there is a major economic crisis, a sharp rise in interest rates, rising unemployment, or excessive borrowing. We saw this in 2008 in many countries. But real estate falls have their own peculiarities. They are slower, more localized, and often recover over time. Most owners do not panic sell. They wait. At this point comes a very important question. What if you believe in real estate, but you don't want or can't buy a real house? This is where real estate ETFs, also known as REIT ETFs, come into play. REITs, or real estate investment trusts, are companies that own and manage real estate. These can be apartment buildings, offices, shopping malls, logistics warehouses, hotels, or even data centers. REITs have one basic rule. They distribute a large part of their profits to investors, usually in the form of dividends. That's why they are considered income investments. A real estate ETF is essentially a basket of many REITs together. Instead of buying one company, you buy dozens or even hundreds through an ETF. This reduces risk and increases diversification, which is very important for low-risk investors. One of the most well-known real estate ETFs in the world is the Vanguard Real Estate ETF, with the symbol VNQ. Its price ranges from about $85 to $90 per share, and its dividend yield ranges from about 3.5% to 4% annually. VNQ offers broad diversification across dozens of US REITs, covering residential, commercial, office, warehouse, and data center assets. Its performance is directly affected by interest rates and the overall market picture, but it largely reflects the course of the US real estate market. A similar ETF is the Schwab US REIT ETF, known as SCHH. Its price is lower, around $20 to $22, and its dividend yield typically ranges between 3% and 4%. SCHH also focuses on US REITs and is considered a more modest option, with low management costs and stable dividend income. For European real estate market exposure, a typical example is the iShares European Property Yield UCITS ETF, with the symbol IPRP. Its price depends on the issue and the stock exchange, but its dividend yield is close to 3%. This ETF offers access to European real estate companies and REITs, reflecting the different dynamics of the European market compared to the American one. In addition to ETFs, Realty Income Corporation, with the symbol O, is also of particular interest. It is one of the best-known REIT companies in the world. Its share price is around $55 to $60, and its dividend yield is around 5% to 6% per year. What makes it stand out is that it pays dividends on a monthly basis, which has given it the nickname the Monthly Dividend Company. Realty Income invests mainly in commercial properties with long-term tenants, offering relatively predictable cash flows. REIT ETFs have gained traction in recent years because they offer something that combines two worlds: the real estate market and the stock market. On the one hand, they provide exposure to real estate and rentals. On the other, they trade daily like stocks. But that means they have both strengths and weaknesses, and it's important to understand both. One of the key benefits of REIT ETFs is diversification. With a single ETF, you can have exposure to dozens or even hundreds of different properties and companies. Instead of relying on the performance of a specific home or retail store, you participate in entire sectors, such as residential, office, warehouse, data center, or commercial real estate. This diversification reduces the risk that arises from problems with an individual property or tenant. A second big advantage is income. REITs are required to distribute most of their profits as dividends, which translates into regular payments to investors. To many, This makes REIT ETFs look like a way to participate in the rental market of the real estate market, without the management and expenses of a physical property. Liquidity is also a major advantage. REIT ETFs are bought and sold instantly on the stock exchange. It doesn't take months to sell. There are no contracts, brokers, or legal processes. This convenience makes REIT ETFs more flexible than traditional real estate, especially in times when someone wants to adjust their portfolio quickly. Another positive aspect is the low initial capital. Participating in the real estate market through a REIT ETF can be done with a relatively small amount, unlike buying a property directly, which requires significant capital or borrowing. This allows for gradual investment and better risk control. On the other hand, REIT ETFs also have clear downsides. The most important is their sensitivity to interest rates. When interest rates rise, the cost of borrowing for real estate companies increases and dividends become less attractive than bonds. This often leads to a decline in the prices of REIT ETFs, even if the physical properties have not suffered an immediate decline in their values. A second disadvantage is that REIT ETFs behave like stocks. Although they are linked to real estate, their price can fall sharply during periods of intense stock market volatility. This means that one can see large fluctuations in the value of their investment, even if rents and fundamentals remain relatively stable. Additionally, the investor has no control over the underlying properties. Unlike a physical property, you cannot choose which property to buy, how to renovate it, or when to sell it. All of these decisions are made by the management of the companies and the structure of the ETF. Another negative is that REIT dividends in many countries are taxed more heavily than dividends from other investments, as they are often considered income rather than capital gains. This can reduce net returns, especially for investors who are primarily focused on income. Finally, REIT ETFs do not fully replace the experience of owning a property directly. They do not offer the same leverage as a mortgage, nor the ability to actively manage the property to increase its value. They are a market participation tool, not a real estate business tool. Overall, REIT ETFs work best as a complementary part of a portfolio. They offer real estate market exposure, income, and liquidity, but come with volatility and interest rate exposure. Their value lies not in replacing real estate, but in providing a different, more flexible way to participate in a market that has traditionally been considered difficult to access. In conclusion, real estate prices do not rise by chance, and they do not rise because the market has decided so. They rise because they are based on structural factors that are difficult to change: limited supply, a constant need for space, and an economic system where inflation pushes real assets upwards. Falls can happen, but they usually come slowly, under specific conditions, and rarely in the way or at the time most people expect. In this environment, participation in the real estate market is not limited to buying a physical property. Real estate ETFs and REITs, such as VNQ, SCHH, European Property ETFs, or Realty Income, offer a different path: more liquidity, wider diversification, and access to rental income without the management and commitment of a property. It is not a substitute for direct ownership, but another way to read the same market. Ultimately, the real question is not whether real estate prices will fall at some point. The question is how one chooses to position oneself in a market that changes slowly but profoundly affects wealth over time. And there, knowledge, understanding cycles, and the right choice of tools are much more important than waiting for the perfect moment that may never come. If this video has clarified the picture a little more for you, a like helps more than you think. And if you want us to continue such analyses, subscribe. See you in the next video.